Hello, everybody. Welcome back to Schwab Coaching for our next topic, getting started with stock investing. Today, we are covering the when to buy portion of this series. Thank you all for joining me. I am your host, Kevin Horner. It is a snowy and chilly day here in Denver, Colorado, but I'm pleased to be here and providing a little bit of a education today on this particular series. Of course, this is a new series that we are working through over the coming weeks here. You can find archived versions of this segment here on the Schwab YouTube coaching channel. Would invite you to utilize those, obviously, to continue building that knowledge base and, of course, to solidify the learnings from one segment to the next. Can be a really good way for you to also come to these sessions live, get your questions answered in the moment. So happy to hear from you all utilizing the chat function over on the right. Now, speaking of chat, my friend Michael Fairborn is in the chat today. He's going to be able to answer questions that I'm unable to get to. But of course, I'm going to work hard to keep an eye on the chat there so I can address your questions live in the moment where possible. But the ones I'm unable to get to, Mike will certainly take care of for me. If you're not already doing so, take a minute and follow Mike and me on X. I am at Kevin Horner CS there, and Mike, you can do so for him at Mike Fairborn CS. That is Mike, not Michael. And of course, you got to make sure you always hit that CS at the end for our monikers. There are our handles on X. Now, before we dive into things today, I wanted to remind you all that we are out among you frequently here in the Schwab events. And in fact, we've got an event coming up in Scottsdale. Now, the one in Scottsdale, I believe, is still available, but filling up quickly. The one in Chicago, a little bit of a smaller venue, but also filling quickly. Because of its smaller venue, you might have a need to speed up if you're trying to get there for us. But always check that schwab.com/events page, everyone, so you know where we're going to be and when. And if you keep a close eye on it, I'll bring that page up for us real briefly and just point out that the in-person events dropdown is updated as our registrations become live for you. So if you keep this page bookmarked and just work your way on down the list, you'll see that where we get the opportunity to get registered, it'll put you there. See how we have down here for Denver, for example, says registration coming soon. So you're not yet ready and able to register for that event, but if you want to make sure that you do get registered, check in here every once a week or so to make sure that you can access registration right when it is available to you so you can secure your location, secure your spot to any of these opportunities. Some of them are workshops. Some of them are market drive events. The biggest difference between the two, your workshop, you come out and we just do an educational series for you 2 days in a row, and you get the chance to bring your device and hook up at your table, get power and Wi-Fi access, and follow along with the educational content. They are a wonderful way, not just to get the education, but also engage with us coaches who are there participating and supporting the event. So if you have that chance, everybody, one in your area or a close enough proximity where you'd be happy to travel, we'd love to have you there. So please join us when you have the opportunity. Again, schwab.com/events or live-events if you want to come directly to the calendar page. Now, before we get into the things today, I do need to remind you that, of course, we're here exclusively for your information and education. Simply put, we're not endorsing any particular underlying stocks, obviously. We're not endorsing a particular approach to trading the market specifically. Please keep that in mind. And today in particular, we are going to be talking a little bit about technical analysis. The real big takeaway I want you to have from the generic and low level of technical analysis we're talking about today is just that, like any analysis, fundamental, technical, otherwise, it's all just a piece of the puzzle for you when you start basing decisions on, when you utilize this information to base your decisions on how you want to adjust your investments in the marketplace. Buying and selling based on any combined piece of information is appropriate, meaning simply take as many pieces of info as you can to base these decisions. What we don't want to do is get locked in to only one viewpoint and utilize that one viewpoint exclusively to base all of our decisions. And so we say that quite frequently about technical analysis. We don't want you to use exclusively technical analysis to base your decision making. Now, I noted earlier this is a series. This is essentially what the series is designed to provide education on as we go forward throughout the weeks. And so we've touched on growth and value stocks, what they are, and today's class is a follow-up to last week's, where we talked quite a bit about the what to buy concept, and today's is going to focus more on the when to buy. So we often say it, and one of my viewpoints that I try to share frequently is that we will often utilize fundamental information, the underlying health of a company's balance sheets, how they generate funds, revenue, etc. Utilize that to build a list of companies in which you would like to invest. It doesn't always mean that that's the right time to invest. If you're going to do so in trend analysis, what we often say is you utilize that list and you find the times when it's appropriate to be investing in those companies. And that's where the when to buy viewpoint begins. It's what we talk about with trend analysis and some semblance of technical analysis. It's what we talk about quite a bit on this particular channel, is understanding trends and utilizing those to our benefits as best we possibly can. So we're going to cover all of these today. And of course, we're going to utilize the Thinkorswim desktop application to highlight some of these learnings. So why don't we get right into it, everybody? We're going to talk about these concepts, these technical considerations that you want to have when looking at price action. One of the key things that we talk about with regards to price action is the standard idea of what creates a trend. And so a trend is created by a few different options. We can have uptrends, as you would see on the chart here. Notice how the price action in this chart, this bar chart, reflects lower left to upper right. By generic definition, we can call that an uptrend. We can also highlight that throughout this trend, there are points where price makes a higher low and price makes a higher high. And so if we were to simply look along the way here at these areas where price retreats to the line that you see through price action, that line here is a 30-day simple moving average. And when I place that cursor on the chart here, you'll see we have instances where price trades below that 30-day average price. Well, instances where trades happen below that price, or that average price of 30 days, have been opportunistic for the trader willing to participate. Now, what you're looking at in the way of that 30-day moving average, let's define that just to make sure that we are all clear on this. This is, simply put, takes the closing price of the last 39 trading sessions, pardon me, 30, not 39, I don't know where that 9 came from, but 30 trading sessions. We add them all up, all those closes, and we divide it by 30, and that gives us a point on this line. And for every day along the way, that line makes an adjustment based on the current day's price action. Now, when you have a 30-day simple moving average, very simply put, all of those prices, all of those price closes are equal to another. That's why we call it a simple moving average. Now, 30-day simple moving average takes into account a time frame of not just 30 days, but think of what 30 days represents, everybody. That's a 6-week window in terms of the calendar, right? 5 trading sessions a week, and then 6 weeks gives us 30 total trading days. That's what the 30-day moving average is providing for you right here. So it's giving you a smooth price and a smooth view of the average price over time. Now, what's cool about moving averages is that in certain circumstances, in certain periods of time, you will find certain moving averages to be providing you a viewpoint of potential support, sometimes a view of potential resistance. But the one thing they will define for you quite clearly is whether you have a price trading in a consistent trend with the time frame that might make sense to you. So while we're looking at a 30-day moving average on this chart in particular, it doesn't mean that 30-day is the proper time frame for you. Some traders, that moving average is way too fast, and they want to look at something much more long-term in nature, perhaps a 200-day simple moving average, more like a 10-month simple moving average. Whereas some traders might want to use a 10 or even 20-day moving average that's going to be speedier than the 30-day moving average, okay? So simple moving averages help us to smooth price action. They help traders to identify trends a little bit more consistently. And for the trader who has a well-defined window of time, the trader or investor, they can utilize the proper moving average as it relates to their long-term or short-term viewpoint, okay? So on the chart, we've got a clear uptrend in place. We see that 30-day moving average. We know that that's kind of in the middle of our time frames, right? 50-day, 30-day, 20-day, maybe 200-day. All of these could be pertinent, just dependent upon your time frame as a trader. Okay, so ultimately, while we are happy to understand trend, we are always thinking about price action from a standpoint of two key definitions: support and resistance. So let's define these first, and let's work to understand these. And then as we go forward, it'll help us kind of get a better clarity on understanding trends. So support is essentially a floor. It is a spot where we have seen price action retreat to, but then we have witnessed price action bounce from said floor. In an uptrend, the support zone, whether it be a line like we've drawn on the chart here in yellow, or maybe a range of price, as I like to draw sometimes, which would be more consistent with like a rectangle that you might draw on the chart, reminding us that we don't want to be too fine in our definition of support or resistance. But if you think about support in an uptrend, what we should be seeing is that the support line, the floor or the yellow line on this chart, should be willing to give some bounce to our price. And that's exactly what we got on this chart, right? We had been through the moving average to the upside, but then when we retreated to it, we tested it, traded down to that zone here, then we bounced off of it. We did the exact same thing about a month later, it looks like, and we bounced off of it. That is a confirmation of what we would call support. So this floor has held and maintained our support. So, as you can read on the screen here, support is your floor, resistance is your ceiling. The hardest part to grasp onto, I believe, when you're learning about trend analysis, support and resistance, is to recognize that what you've deemed to be support can quickly become resistance when price moves through support to the downside. So in our chart here, where we've had those tests of support, if price action fell through to the downside, this would be a significant development. And that yellow line would then be our ceiling or the resistance level that we would need to get above once more to create it as a ledge of support for us once again. So support when broken to the downside becomes resistance. Resistance when broken to the upside becomes support, just as the last two bullet points here really lay out for us. Okay, so this is ultimately really the only thing that matters in terms of technical analysis: support and resistance. And yes, trends play into it, but understanding that very basic levels of price action and mentality of price action as we move through areas of resistance to the upside or through areas of support to the downside, understanding what these movements are really telling us is part of really just spending that time to really get familiar with the market and the way the market works, the way that price action works, and how traders use these levels to really understand what could come next. Okay, Next, we're going to talk briefly about some technical indicators, but I want to just remind before we shift off of this, try and remember that support and resistance really is the most important aspect of technical analysis because that carries through every step of the way. Even though we're going to talk briefly about many of these technical indicators that traders might incorporate to their process, they're nothing more than alternate ways to evaluate price action and volume ultimately. And you can utilize these many other indicators, maybe like the MACD that you see here at the bottom of this screen, or you could utilize these moving averages as we've talked. There are many options for you when it comes to applying technical indicators to a chart, but it doesn't necessarily mean you're going to be able to make better decisions simply by having more information at your fingertips. It is often stated that one challenge to technical trading, to traders who utilize charts, is the idea of analysis paralysis. This absolutely can occur. And so inevitably, traders learn about these individual studies and indicators that can seem to be helpful in certain circumstances, and you apply those indicators to working on one stock, and it works really, really well. And then you say, all right, well, we're going to use that exact same approach on the next stock, and suddenly that's a different stock. It's a different group of traders trading that stock, and the criteria that you were using to trade the first one, for whatever reason, they just aren't giving you the clearest of signals as you had on the first trade, right? This can happen. And so ultimately, once more, we got to bring ourselves back to the bottom or base layer of what technical analysis is. Very standardized support and resistance, and understanding uptrends, understanding downtrends, understanding consolidation windows or sideways trends. And I think the hardest part, of course, is to evaluate big moves one way or the other and then say, all right, it's made the majority of this move. Now, can I expect the stock to then move into a consolidation period, which is very commonly the case? The question then becomes, how long of a consolidation period, right? How frequently are we going to see a pullback last? Maybe 3 to 4 weeks, perhaps as long as 5 or 6 weeks. Are we going to enter into a sideways price range where you see matching highs and matching lows for an extended period of time? We have all of these trends that we have to probably see live and in the wild at some point in time before we as investors and traders get really much more comfortable with then utilizing price action to base our decisions, right? You have to pretty much see this in the wild, as I like to say, before you can really grow comfortable with it. Wiley, I could not agree more. Price action and risk management, so important to the trader. While we're not talking risk management here yet, it's these concepts associated with trend analysis, support, and resistance that aid us in building proper approach to placing our trades. We will talk about that in another segment, thankfully. The question, Salient Joe, about how many is too many? Yeah, you're absolutely right. That comes down to each of us as individual traders. But I would still challenge you all. Have 1 or 2 indicators that work. Maybe it's the MACD, maybe it's the RSI. Some traders like stochastics, but have 1 or 2, but try hard not to overdo it. And when you find yourself overdoing it, or worse, you find yourself in scenarios where the detail you're working with is giving you maybe poor signals, yeah, that's when we want to fall back on standard, right? Try not to overdo our thought process too much. Let's just look at the basics. And if I was looking at an uptrend and saw the stock kept banging its head on a ceiling, am I going to buy it before it breaks through the ceiling, or am I going to buy it only after it breaks through and tells me that there's strength there, right? Have these plans, stay disciplined, and stick to that plan. Remember, the plan you give yourself is your playbook. That playbook will go a long way towards answering so many of your questions on decision making in the moment. Hopefully you give yourself that playbook and then you're just kind of referring to it when you need to. All right, so technical indicators, a few for consideration. We're not going to get too far down that road in terms of understanding specific technicals. We're going to lean more into trends here today. Let's talk a little bit about volume as it relates to price action. Volume is where you're going to find it most commonly is at the bottom of a graph like you see here, this section down below. Now, many of you have the opportunity to, and if you're utilizing Thinkorswim, we all have the opportunity to separate volume as you see it on the chart here. Some traders like to do that in an overlay fashion where volume is actually on the sharing the same pane that is as your price action. But a lot of us like to see volume separate like you see down below. Now, a friend of mine refers to volume as your rocket fuel. It can be the indication that what the move you're seeing is validated. So if you've got a stock moving to new highs and doing so as volume has been increasing along the way, that validates commonly the move in price action. So volume can be confirmatory in nature for trades that are showing moves to new highs. It can be confirmatory in nature for trades showing you prices moving to new lows. That can confirm a downtrend as well. But if you're looking for volume to be the clear delineating factor in every circumstance, I don't know that that's going to be the key component for you. It can be used as confirmation, but what I want to remind you about is where it says volume is frequently used to validate or as confirmation. It doesn't necessarily mean that movement to new highs on light volume is suddenly invalidated. Don't make that mistake. Remember, whenever you're talking trend analysis, price is king, okay? Price is the number one thing that matters. Yes, we would love it if as we move to new highs, we get high volume, big volume relative to average. Great indication that price is validated, but don't be misled that prices at new highs with lighter volume relative to average mean that the stock can't continue higher or that price can't hold. That can definitely be the case. And as you go forward, again, understanding these thoughts that, yeah, we'd love volume to confirm things. That would give us confidence, but you don't have to have it for prices to continue to move. It can be used, though, as a decent indicator of whether or not we've got strength behind buying and selling moves, though. Okay, I think now we should look for some examples. And I'll tell you, when I start talking examples from trend analysis, like we're going to look at here, I can't help but go to the S&P 500 because it's obviously the 500 largest companies in the U.S. and they are really consistent from a trend standpoint. And we're going to look at that here on what I have is a maximum chart here, everybody. And, you know, this is, as the S&P, this goes long range, everyone. As you can see, this goes back to 1998, as it turns out, the fall of 1998, shortly after I joined Schwab, when the S&P was hanging out somewhere in the neighborhood of about 1,000 points total. Here we are at 6,000 points. So not bad moves. But what I think what I want to point out here, of course, is how we've had a series of uptrends and downtrends and sideways trends in the entire window of what amounts to about 26 years or so, right? So let's drill into some windows here and see if we can define them. I'm going to start from the most recent period right here, and I'm going to simply add some lines in. Now, what I want to point out is we are working on a weekly chart, okay? So when I add these moving averages, average price, we're going to be talking about them briefly as though they are weekly moving averages. So I'm going up to my beaker, and I've already got these applied. I'm just going to highlight this eyeball icon so they get placed on the chart. We are adding in a 20 period simple moving average. So that is, in this case, a 20-week simple moving average. And when you look at price in the S&P 500, dating back to, we're going to go back to January of 23, okay? That's just where we start. Note how this green line, as the average price, retreats to the green line where your opportunities to join the uptrend, right? Right along the way. So if you just said, oh, you know what? I'm going to use instances where the S&P 500 trades at or below its 20-week line, 20-week average price. Those are going to be instances where I will devote new money to the S&P 500, because in the midst of an uptrend, those have been instances where joining the trend would be low risk in the sense that you are adding it along the standard trend line. In this case, the average price of the prior 20 weeks. Now, you can apply longer term timeframes to this as well. We could add a 40-week simple moving average too. And so now what we've got are two different lines, and those two lines taken collectively or together, we've only had one instance where we closed below both for a period, and that was very short-lived and an excellent opportunity to participate in the new uptrend thereafter. Okay, so there you have use of the 20 and 40-week moving averages to define a much longer trend. And that much longer trend really has been working for quite a while. I mean, the consistent move has started from that October of 2023 window, and that's the current uptrend we're working with, right? But if you'll note, as we go back in time a little bit, we also had a pretty healthy downtrend right from what was January of 2022 to all the way to the October period of 2022. So we had about a 10-month long downtrend, even though the long run would tell you we've also had a bull market going back to at least 2010 or spring of 2009 probably, where we were working through the great financial crisis and beginning the new uptrend. But what I love about a weekly chart is it's pretty simple to find these periods of time where we have long uptrends, right? Notice the green 20-week moving average, uptrend working beautifully until all of a sudden we don't. And now we are in a downtrend until that downtrend breaks, right? So you've got something like this channel, something like this. And then only once we got outside of that channel with price action, notice how those moving averages started to curl upward. And then how does that go again? What was support along the way became resistance, and price stayed below the green. And if it got through the green, it looks like it got rejected at the white line, right? Let me pull these little trend lines off once more. But see how, we break the green line, break the white, then, so green was support along the way, green became resistance. Same with white, right? So 20-week in green, 40-week in white, resistance, 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 until it wasn't. And then once we got above it, then it could become support. And that's why this window right here would have been the hardest window to be confident that you were on the right side of the market, right? All right. So this is like the turning point here. This bubble right here on what was essentially March of March of 23 here, when things started to turn the corner. Okay. And from there, you could see while we built a long range uptrend, we've had small downtrends in the middle of it, right? Small retreat, short-term downtrend to the trend line, short-term downtrends, that bring you to areas of potential support where you can participate, right? So let me get to some of these questions for you all. I want to try and help out as best I can. Okay, good question, Long Snapper. How does this help you today to know when? I mean, obviously, we're looking in hindsight. And so your question is, how does this help if you want to know what to buy today, not the times that you missed? This is a great question. Ultimately, what you're asking is, hey, what I'm looking for now are stocks that are already having made these downtrend moves and might be residing at the green line for 20-week support or the 40-week moving average for support. Right now, this just means that the S&P 500 isn't pristine in that setup. But there are many techniques that traders will use to look amongst the marketplace to find these instances. So if you know, for example, that you want to be a buyer of stock that have retreated to areas of, say, for example, a 40-week simple moving average, well, we can incorporate that into a scanner tool within the Thinkorswim platform here to locate stocks that are in that area of the market. You're not wrong, Long Snapper. Technical analysis does nothing more. It can't look forward in time. It only looks backward. We have to have price action historically in order to use technical analysis. Now, it might not be perfect to buy the S&P 500 right now, but what you can suggest from the trend is that what we see in price action, the trend is upward in motion. We are approaching highs or have struggled recently to make highs through 6,100 that have been held, haven't done that yet. But what this can tell us is that we have a strong uptrend in the S&P 500. Heck, we could even sell all the way down to about 5,700 in price and still be considered in the uptrend. So what it reminds us, Long Snapper, is that we have homework to do. Our job is not to pull up this every single day and say, boy, I hope there's some stocks out there for me. My hope is that you've got an entire list that you are watching and monitoring and looking for the proper time when it is appropriate to devote money to those positions. That's the way I believe traders want to utilize this type of analysis. Are you going to be looking at the market some days and some days you're just sitting on your hands? Absolutely. Not every day is a day to place trades in the market. Not every day is a day to devote money for your long-term investment plan necessarily. My hope is that this goes a long way towards helping to understand that trend analysis as it relates to the current market and hopefully can help demystify some of what you might hear from the analysis conversations we have here on the YouTube channel. And you can utilize these conversations to your benefit going forward. So that's how I want you to think about it. You know what? Technical analysis is only backward looking, though. So you're not wrong about that. But it does mean that we as traders have to be comfortable, traders and investors alike, have to be comfortable with what the trend is telling us. And then further have to be comfortable to say, well, I'm not going to like the S&P 500 when it's down 400 points from here. Inevitably, we're going to all hate it. But if it's down 400 points and sitting on that white moving average, how many traders are going to look at this and say, well, you know what? The last two times it's come to the white line or gotten beneath it, those have been your buying opportunities. Why wouldn't this be my buying opportunity as the S&P retreats from 6,130 down to 5,700? If that were to occur, the likelihood is strong that you're going to have access, or I should say, a lot of interest at that price level. Okay. And that can be the case for the S&P 500. That can be the case for your individual stocks as well. Now, we've been talking about the two main scenarios, right? Uptrends working against the moving average, downtrends working against the moving average. There are also periods, though, where we just go a little bit sideways. We'll have a few of those. Let's see here. Let's zoom us into back here. Before we got really exuberant in that year 2016 period, we started to really take off. So you'll notice in here, everybody, we had been taking ourselves into this zone of resistance pretty consistently here. Draw that in. All right. And then we'd also been bouncing off of a zone of support here as well. Let's update that to green. So coming into this, I'm going to back this off a little bit further. Okay, so we had a nice long uptrend. We're just going to stop before we actually break out. So we have a nice uptrend working, right? Remember those white and green lines, everybody? We've been working with the 20 in green and the 40 in white. I think that's white. Again, my eyesight might not be great. That could be light blue. I apologize if that's the case. But does this look a whole lot different than instances we've seen recently in the S&P 500? Not so much, does it? It looks very much alike. And what we had ultimately was a wonderful move off of this extended low. We can just draw a line. I like to draw a line so I don't have to do the math. So if I draw this line from the bottom to the peak and hover over that, that line says 97.8%. It took 190 bars. So 190 bars, somewhere around, what are we looking at? I mean, 1,323 days, about 3.5 years it took. Great little run though, right? Then we get to this point where we are struggling and can't push through that level. Okay, and we did eventually push through it, but look at this price range. What are we talking about? This is October of 2014, and we didn't break out of it until July of 2016. So almost 2 full years, everybody. So 2 full years, and then we finally broke out of it. This would be, for many traders, called a consolidation. Okay, so we had prices move really strongly to the upside, and then we went sideways until we got out of it. And this getting out of it was the key, right? So traders were able to buy around support and sell around resistance until we broke through it. And then remember, support and resistance. Once we break resistance to the upside, our hope is that then that can act as support for us. And as you notice, it kind of did, but we had to actually get back to that moving average as support here. And that's when things started to take off for us again. And that happened to be in about the late fall of 2016, it looks like. So we had this lovely consolidation move, difficulty. I mean, I remember speaking about this, talking about our inability to move through 2125, 2150, and how tricky that was. And we were just waiting for that breakout. And then eventually we got that breakout. We got the test at the moving average. And then it was just, hey, new trend working against these new speedier moving averages. So I noticed I got a couple of specifics in here. Let me get to your question. So Tatiana, your question about these moving averages. Let me just say, the moving average is likely defined as most commonly one of two things: a simple moving average or an exponential moving average. The difference between these two is that a simple gives equal weighting to all of the days or periods in the moving average itself. Exponential will put a greater importance on what's happened most recently. You'll get maybe faster signals with exponential, but faster, more speedy signals doesn't necessarily mean accurate signals. So bear that in mind. Some traders have a preference for utilizing exponential moving averages. It really is a trader's preference. Now, as it relates to the chart you're looking at, if you're applying a moving average and you're looking at a weekly chart, well, then the moving average is a weekly moving average. So in my case, it's the green shows here 20. That's a 20-week simple moving average, or a 40-week simple moving average. But the moment I shift over to my daily chart and apply my moving averages, these are a 20-day, a 200-day, and a 50-day moving average. And you'll notice here, everybody, I've got those lines on the chart too. But look at my ovals, where my ovals and instances to join the trend come into play. They're below that purple line, the purple line, is my 50-day moving average. This just gets you to a point of needing to get comfortable with the most commonly utilized moving averages, I would suggest. And I think this can go a long way towards helping us as traders recognize our opportunities to participate. Yes, we've got these bubbles below the purple, below the orange. So we are below both the 20 and 50-day simple moving averages. But that blue line is the 200-day simple moving average. You'll notice that while we've been below the 20 and the 50 number of times in the last year plus, we have not been below the 200-day moving average, or we have to go back in time to find the instance when we were below the 200-day right back here. Okay. All right. So I hope I answered your question there, Tatiana, about these simple moving averages. I hope that was helpful for you. Let's see. Okay. All right. So this is, again, I know one thing I wanted to revisit briefly as we look to get kind of a wrap up on this view of discussion, everybody. We've got trends up, trends down. We've got consolidation or price action moving sideways, like kind of like what these white lines are defining right now, right? Notice, because we haven't moved to new highs here yet. But ultimately, we are still looking at the same stuff, aren't we? I would call this resistance, right? Right here. I'm probably change my arrow the way it's supposed to be. We'll line that properly. So there's your resistance. I'm going to duplicate it, put it right here. Here is your support. I mean, yeah, are we in an uptrend still? Absolutely. But if we traded on price through this resistance band that I've placed here, well, then we could make this green line now support. And that could be our opportunity to verify or validate the trend as moving higher and giving us the chance to participate. So, you know, trend analysis, again, doesn't have to be a dramatic amount of effort. But the one thing I can tell you is there will be no substitute for looking at charts. The more charts you look at, the better it becomes, the easier it becomes in identifying trends and recognizing that these trends are consistent in both daily charts, weekly charts, monthly charts. You can go to intraday charts as well, hours, 15-minute blocks, 5-minute blocks, take your pick. But technical analysis, trend analysis, you will find it in all time frames that you choose to look at. Okay. The last main cog as it relates to understanding trends, though, is to remember that one of the reasons I start from the weekly chart is that the weekly viewpoint, and just the longer the trend viewpoint, the knowledge that the longer a trend has been in play, the stronger that trend is considered. Okay. So while we talk every day about the current spot, the current scenarios of the market, what are we paying attention to, what matters, etc., for a lot of investors, that day-to-day stuff is just noise. And you can fall back on the weekly chart for a better understanding of true trend and be just fine with understanding where we reside at any given moment in time. So with that, we'll wrap it up. But I want to invite you all to come join other classes besides this one. Getting started with stock investing is very foundational in nature, but you can do a lot for yourselves by simply staying apprised of what the market is doing day to day. Again, it might be noise from a decision-making standpoint, but it can go a long way towards aiding your further education and understanding of day-to-day and week-to-week market mechanics. It's a big part of furthering your knowledge. So join us for other sessions. In particular, I host Trader Talk on Mondays, Wednesdays, Thursdays, and Fridays. That's at the opening bell. And this level of analysis is what we center on every single day we host that session. So I would love to see you all in one of those sessions down the road. Take a moment and follow me and Mike on X if you're not already doing so, Mike Fairborn CS and Kevin Horner CS, and hit that thumbs up button for me as well if you don't mind, everyone. It goes a long way towards getting us up the algorithm here on the replay, which I expect to have available for you as early as tomorrow morning. So big thanks to you all for your good questions. I appreciate those. And if you're catching us in the archives, remember this session is live on Thursdays at 3 p.m. Eastern. So we would love to have you join a live session as well and get your live questions answered in the moment. So with that, I will wrap. Thank you all for joining. Have a fantastic Thursday, everybody. I look forward to seeing you all again real soon.